Have you ever entered a trade, got stopped out, and then watched the price move exactly in your direction? That's not bad luck, that's liquidity. In the next 5 minutes, I'll show you how the market actually traps traders. In this video, I'm going to break down how institutions actually move the market. No indicators, no guessing. In the next 5 minutes, I'll walk you through 6 key concepts: impulse moves, order blocks, change of character, fair value gaps, liquidity sweeps, and inducement. They aren't random patterns, they are the logic behind every major move you see on the chart. Let's get into it. An impulse candle is a strong, aggressive move in price, usually represented by a large candle with very little wick. This type of candle shows strong participation from institutions and indicates imbalance between buyers and sellers. Impulse moves are important because they break structure, create fair value gaps, and often originate from order blocks. When you see a sudden explosive move, it's a signal that smart money has entered the market. In simple terms, impulse candles tells us who is in control, buyers or sellers. An order block is the last bullish or bearish candle before a strong impulse move. It represents an area where institutions place large buy or sell orders. Price often returns to these zones because big players cannot fill all their positions at once. When price revisits an order block, it often reacts strongly, making it a high probability area for entries. Think of order blocks as footprints of smart money left on the chart. In the later part of the video, let's understand how inducement gonna complement order blocks and make it very high probable entry setup. The third concept is change of character. Change of character occurs when price breaks its current trend structure. For example, in a downtrend, price starts making lower highs and lower lows. When price suddenly breaks a previous lower high, that's a change of character. This tells us that momentum is shifting and that a possible trend reversal or correction is starting. Change of character is an early warning sign that the market narrative is changing. Fair value gap. A fair value gap is a price imbalance created when the market moves too fast, usually during an impulse move. It appears as a gap between candles where price did not trade efficiently. Markets are designed to seek efficiency, so price often returns to these gaps to rebalance before continuing its move. Fair value gaps are powerful areas for entries, targets, and confirmations. Simply put, price like to fill the gap before moving on. Liquidity exists where traders place their stop losses, such as above highs or below lows. A liquidity sweep happens when price intentionally moves to these areas, grabs those stops, and then reverses. This is not random. It's done by institutions to generate liquidity for their large positions. Once liquidity is taken, price often moves aggressively in the opposite direction. So, liquidity sweeps are traps for retail traders and opportunities for smart traders. Finally, we have inducement. Inducement is when the market lures traders into false entries before making the real move. Price might form a small breakout or trend continuation, encouraging traders to enter early. Once enough traders are positioned, the market reverses, taking their stops and using the liquidity to fuel the true direction. Inducement teaches us patience, waiting for confirmation instead of chasing price. Inducement into an order block is generally considered a high probability move in the reverse direction. So now you know the market isn't random. Those impulse moves, fake breakouts, and stop loss hunts all follow structure and liquidity. If you start waiting for liquidity to be taken, structure to shift, and price to return to key areas, your trading changes completely. Rewatch this video, slow the charts down, and start spotting these concepts one by one. If this helped you, like the video and subscribe for more simple, no noise trading education.